Hello, I'm Liz Lumley of Finextra, and today I'm speaking to Joseph Morris-Trupin of Misys. So Joseph, we're going to talk a little bit about commercial lending. So what are some of the key trends you're seeing from banks right at the moment?
So Liz, the number one thing that bank executives are concerned about right now is how to improve the return on equity of the bank. Right now, the banks in the United States are returning barely their cost of capital, and in Europe it's much worse. Now, this is a serious problem because it's not simply about improving the share price. Poor return on equity is actually threatening banks' future access to capital. And this ties in directly with what banks need to do with their commercial lending programs, because lending is such a capital-intensive business.
So what are banks doing to improve this then?
So in order to improve return on equity, banks need to do three things. They need to build more efficient operations. They need to better price and manage risk. And perhaps most importantly, they need to use their balance sheets more effectively. So what's challenging them as they attempt to do this is primarily the sheer number of software applications that banks have accumulated over the last 15 to 20 years in the commercial lending arena. Now, this has happened for a variety of reasons. Banks have merged, sometimes repeatedly. Banks have extended into international operations, offered new financially innovative products to their customers, and so on. The problem is that all of these applications that they're using are sometimes supplemented with things like spreadsheets, paper, emails, and the applications by themselves have very complex data models which are fundamentally incompatible with each other. So stitching all of this together after the fact is really a problem for the banks, because they need to try to get high quality, highly available information out of the back end. So this is a real challenge. Now, in theory, things like data marts, data warehouses, and so forth are meant to solve this problem. But if you speak to banks privately, the ones who've tried this approach, they'll tell you that in the end it's really Frankenstein's monster. So it's barely stitched together at great cost and effort, and in the end you can't turn your back on it. No one really trusts the data that's coming out of this effort. And if banks cannot get to that global view of their exposure to customers, particular loan products, currencies, regions, and so on, then they can't really manage the risk, they can't identify the risk, and they certainly can't price to risk very effectively.
So where are we primarily seeing this? Is this mostly tier one banks, or is this across the board?
Well, the more geographies, business lines, currencies that the bank is operating in, the truer that tends to be. So further down market with the more domestically oriented banks, you have a different problem. And that problem is that though those banks may be operating on a single platform, those domestically oriented platforms that they're accustomed to really are not offering all of the functionality that they need to break their dependency on spreadsheets, email, paper, and so forth. In addition, they tend not to offer the modern tools that banks really need to help them achieve the objectives we talked about earlier. So they tend to lack things like integrated software development kits that would allow them to customize the system cost effectively, integrated business intelligence tools, analytical tools, and so forth. The third problem is that those vendors, as time goes on, and as the global banks retreat away from those software products, have less and less financial capacity to improve those products to bring the innovation that their customers are looking for.
So does that mean that we're going to see some of the vendors in this space disappear in the near future?
Well, we can't predict the future, but some of these vendors will certainly be relegated to very small niches within the market. Just as a quick example, one of those vendors in the last 18 months has lost two of their largest customers, both tier one US customers. And we believe that accounts for about 30% of their revenue. So we're really starting to see a rush to the lifeboats as this becomes more visible to their customers and to the market in general.
So what are institutions doing about this then?
Well, we see that more and more institutions are migrating toward what we refer to as unified commercial lending platforms. And that means a single platform that's providing on the most modern technology all of the functionality needed across all of the business lines and integrated with all of those analytical tools, software development kits and so forth that we mentioned earlier. And here's where it gets really interesting. If you think about it, global banks have the most sophisticated requirements in the market. They're operating in multiple geographies, doing accounting for multiple legal entities in multiple time zones with multiple business calendars, et cetera, et cetera, et cetera. And this is no mean feat. At the same time, because they have the largest portfolios of loans and they need to process them very efficiently, that means that they also have the greatest need for simplicity. And that's been the real challenge for vendors is achieving that balance and delivering the complexity, but only where it's really needed, and delivering the simplicity everywhere else. So while the domestic banks don't necessarily need all the sophistication of the global banks, the unified commercial lending platform is still very attractive to them for a couple of reasons. Firstly is the vendor risk that we talked about a moment ago. Secondly, those global banks are working with companies like Misys to really up their game in terms of processing efficiency and so forth. And the domestic banks can really benefit massively from that. Thirdly, as products like Misys Loan IQ begin to be offered on a software as a service basis, this is allowing smaller customers to participate in business lines in a cost-effective way where previously they couldn't without making a massive investment in a software platform which was dedicated to that business line, or at least purchasing a major module within a platform. So that software as a service offering is allowing these customers to actually deliver the products and services that their customers want in a cost-effective manner.
So you mentioned commercial real estate a number of times. Is that an area that banks are focusing on right now?
Absolutely. So the good news in commercial real estate is it turned out not to be the other shoe waiting to drop that some people thought it would be back in 2009. The other good news is that that really exposed, without any serious consequence, some very serious shortcomings in the way that banks manage their commercial real estate portfolios today. And off of that, these global banks are now working with companies like Misys to bring together for the first time all of the data required for managing commercial real estate portfolio under one roof. So ranging from the loan to the collateral and the management of perfection of the collateral to escrow to construction budgets and so on, these banks are now looking to pull all of that together into one rationalized platform in a way that really hasn't been done before. And this is especially true around the collateral aspect. So previously, commercial banks really weren't capturing so much data about the collateral. And what they were capturing was very often being housed in spreadsheets. And of course, again, on a global basis, this is simply impossible to really understand the collateral that you have. What we're doing with banks now, it really allows them to capture all of the data that they need per region, per type of collateral, and this is allowing them to generate investor reporting for commercial real estate, environmental reports, and so forth. They're also looking at capturing information about real estate collateral all the way down to things like the rent rolls, so that as they look at a piece of income producing real estate, they can actually look into the economics of that piece of collateral and see not just is the loan likely to be performing today, but what will it likely look like in a couple of years' time. So in turn, this is allowing banks to identify the deals that will need to be managed most proactively going forward, the deals that they want to sell down out of their portfolio. And swinging back to return on equity, it's really allowing them to resume the package and distribute model that they've been struggling with ever since the beginning of the financial crisis.
Excellent. Thank you very much.
Thank you.